So socially responsible investing is getting the priorities straight, and you can see the cartoon here. Uh, with some irate people who are sincerely irate. It should be after what happened in 2008, and I'm just going to skip straight to it. So, what do I see my job as? I've been doing this for 17 years. Stop the transfer of wealth from retail investors to the big banks, insurance companies, and other institutions like hedge funds. The way we do it is first we identify the risk budget, then we educate the risk, allocate risk to the investment environment, and address financial planning needs. So it's a process, it's a system. And every piece of this, everywhere that we're doing it, we should be thinking about how we're doing it. And I think it's very responsible to get those big banks and insurance companies out of it. Make sure we're doing the risk budget is one way to do it, educate to it, allocate risk to the investment environment, and address planning needs. These are all facets of it. And we can get specific to the securities, but boy, oh boy, do we need to get this right first. So I'm going to get two charts here, or three, on just Trump, just to kind of put this in perspective. The bloodless verdict of the markets. President-elect Trump spooked the international and emerging markets. He did. But President Trump has been better for international and emerging markets. What? That's a surprise. President Trump has been better for international and emerging markets when everybody thought he was going to start a trade war. If you look at this, what did real well after Trump got elected and before he became the president? So from November until January 20th. Banks did 20%. The small caps, yeah, 14% they're up. Of course they're up a lot. If you think there's going to be a trade war, who's going to benefit? U.S. focused companies, small companies. Big companies did all right in the U.S., 7%. Outside of the U.S., they made 5%, and emerging markets were down. Bonds were down. All right. After Trump got in, what happened? Well, after Trump got in, emerging markets did best, followed by international stocks, followed by big U.S. companies, and then small caps and banks. So it's kind of, not at all what was expected. But everybody's happy so far. And I only bring this up because some of the folks that have come to me, particularly in North Carolina, for socially responsible investing, are just upset about everything, and they want to allocate to alternative energy and marijuana stocks. Specifically, those two have been brought up many times. So what we have right now is a major problem that exists because people aren't doing what is in their best interests. So investors are terrible. And retail investors invested in the biggest international stock fund for the last 10 years when they could have made almost 2.5% for the 10 years ending April 2017. They made 0.8. In emerging markets, the biggest emerging market fund, if the fund itself made 2.3%, retail investors in the fund made 0.4. Now, these returns come from cash flow weighting. In other words, when people put their money in. In other words, people usually put the money in after the fund's done real well and take it out after it's done real bad. So they time it almost exactly wrong. This is a video loop. It plays over and over, and it's my job to try to stop it. So as you can see, it happens with international funds. It happens with emerging markets funds. And guess what else it happens to? It happens to the biggest U.S. fund that we have, which is the Vanguard 500 Index. It made, for the last 10 years for this period, 7% per year, but people in it, retail investors in it, made 3.1%. Well, if it made 7% and retail investors made 3%, who made the other money? So somebody else did. Not only that, they had to make more than 7 for the average to come out to 3. And you know who that is? That's institutions. It's the big 4 banks. You know who they are. It's the insurance companies, and you can name those. It's hedge funds, and it's people, because for every seller there's a buyer, and every buyer there's a seller. It's people doing the smart thing. It's people who are patient. It's people who are calculating. It's the Vulcans versus the humans. That's what's going on, all right? So it's a zero-sum game, and retail investors have been played for suckers, all right? Sustainable investing refers, ESG is something that's very de rigueur at the moment. We heard about it from folks in Chicago at Morningstar. Environmental, social, governance issues. Sustainable investors, increasingly traditional investors consider when making investment decisions. I've had a couple people come to me, as I said. One of them was a Muslim, a Sunni Muslim, and he adheres to strict Sharia. Now, the guy's been fooling himself his whole life. He's 68 years old. He's in the Vanguard Windsor Fund in his 401k, and he's chosen not to look because it does not in any way adhere to Sharia principles, because Sharia principles are strict, so strict. I'm probably not going to, and I really like this guy, work with this guy. I'm probably not going to be able to work with him because he can't take interest. He can, it's called, they call it usury there. It's like old school Old Testament. You can't get paid any interest. You can't invest in tobacco. You can't invest in specifically tobacco, specifically alcohol, or anything that makes money from interest. Whoa, no banks, no a lot of things. Environmental, social governance issues are climate change, carbon, air, water, energy efficiency, waste management, water scarcity, biodiversity, and deforestation, social, gender diversity, human rights, labor, employment, customer satisfaction, community, governance. You can see what these things are. These are ESG. Morningstar has a way to rate funds by ESG. They have a way to rate funds by sustainable. It is very, very subjective. It's so subjective, I don't understand it. There are funds out there that say we are socially responsible funds that get a 1 star from Morningstar for the sustainability. There are funds out there that don't claim to, that get 5. It's, I don't know where. It's very, very difficult to understand. So this is really a very, very customized solution for an individual client. And it's something that you can go down this rabbit hole if you want to, if we don't find another way around it. And so that's what I generally do with clients, we find a way around it. So again, just wanted to show this. If this is what the Vanguard S&P 500 did, investors only kept 37% of the total return that was there. I think this is a huge issue that we can deal with. Similarly, with Dodge and Cox International and Vanguard Emerging Markets, 70 to 84% went to other people than the investors themselves. I think that's a big issue. I think that's a social responsibility issue. Let's not let them have it. So again, this is my job. I talked about it a minute ago, stop transfer of wealth. And the first thing that we do to do it is we make sure that we identify the risk budget for the client. So I can't believe it. I mean, I'm flabbergasted all the time by things that people don't do that to me make so much sense that not doing it I find appalling. But hardly anyone does this. And we're a little old 200 whatever million dollar RIA. We're not a $2 billion or a $20 billion RIA. But every client that we bring in, we make sure that we get an accurate and statistically valid psychometric risk assessment of them. Because guess what? This is something that works. The average score of the Phenometric Risk Assessment is the same for the last 10 or 15 years. It hasn't changed hardly at all. So when the market goes way up, the average doesn't go up. When the market goes way down, it doesn't go way down. Well, I can tell you that I've seen some similar things with the 6 or 7 questions everybody asks, and almost always are they skewed by current sentiment in the market. So when people are bullish, they're more risk tolerant. When people are bearish, they're less risk tolerant. And that's exactly the wrong time to have that attitude towards risk. You should have the opposite of how you feel in general. So we have this stable allocation, and it's something that's going to, in my opinion, substantially reduce some of that transfer of wealth. Now, educating to risk. This is something in Chicago. I talked about this with some of the behavioral psychologists. They were kind of interested in it. They said, "Wow, you got to tell me how you do that." I said, "Okay, here's how we do it." And here's how we do it. What we do is have our clients internalize what it is to make the wrong decision or the right decision when they're making an investment decision. So I'm going to take you through a game here real fast. Okay. This game, I call it the $4,000, $3,000 game. So the first day I'm coming to you and I'm a bad guy. I got a big old gun and I'm saying, "Hey, you have to give me money. You don't have a choice. We're going to play a game here. You can take choice A, where you give me $3,000, or I'm a good guy. I'm going to give you a chance to not do that." You can take choice B, where there's an 80% chance of you losing $4,000, but there's a 20% chance you don't have to give me diddly squat. Okay, so you get to make that choice, but you have to make it. So if you're sitting there at home, maybe you could just write it down. Which choice do you make? Would you rather have A, you give me 3,000, or B, you might have to give me 4, you might have not have to give me anything. Okay, so that's where you give me money. Now the second day, I know I'm getting older and I'm not as attractive as I used to be. And anyway, I'm going to send a young lady with flowers, and she is going to give you something. She's going to give you C, $3,000 outright. Here it is. You can have $3,000, or choice D, which is there's an 80% chance you get $4,000 and 20% chance you get zero. So when the money is given to you, which choice do you make? To write it down, C or D. Okay, well, this is a game that's been played a lot over the years. This is written in a book by Daniel Kahneman. I used this game, let's see, what year is it? 2017. I used this game in 15 years ago with clients. I've been using this game for 15 years. And the reason is because almost everybody makes at least one wrong choice. Now, let me just back up a second. If I came to the door of Warren Buffett, he'd know the game. He plays this game every day. Warren Buffett would say, okay, on day one, I'm going to take choice B because my calculator says that zero point 0.8 times 4,000, it's 80% of 4,000, is $3,200. And $3,200 is more than A, 3,000. So I'm taking B. On the second day, I'm going to take choice C because I'd rather give you $3,000 than an expected $3,200. Well, I bet you're not Warren Buffett because 92% on the first day chose B, but only 20% chose D, 80% chose C. So 92% got it wrong on the first day and 80% got it wrong on the second day. So if you got it wrong, well, you're in good company. And that is the reason that most people need someone to guide them because ambiguity is there and you've got the big guys trying to take advantage of you. So we educate the risk. Another way that we educate the risk is if you're taking half the risk of the market, then you should expect to get half of the downside and half the upside of the market. Now, if the market, the S&P, over a given 6 months at 95% confidence, that's 2 standard deviations in statistics terms, it's a pretty good confidence level. It's going to be most of the time. You're going to be somewhere between minus 21% return, which would mean if you had $1 million, you'd be down to 800,000. Or you might get 28% on the up. You might be up to almost 1.3 million. If you're taking half of that risk, portfolio 4, the moderate portfolio, you'd be down a little over 10 or up 14. So down to a little over 900,000 or up to 1.14 million. Similarly, if you take a 2/3 or a third, it's going to be a little bit different. So it's important for people to kind of understand that, to kind of bound your expectations. This is what might happen to you when you're doing this most of the time. If it's in those bounds, don't fret too much. If it's outside of that, well, that happens too. That sure happened in 2008. But the last 2008 was 30 some years ago. We haven't had that bad of a market in a very long time. I don't know when we're going to have another one like that, but the tea leaves that the economists are reading that are telling me say that probably not soon because the market is generally not crazy when you don't have a bad economy, and we don't have a bad economy. We don't have a great economy. We don't have a bad economy. So the other thing to consider is let's say that you scored in the middle. You're a moderate investor, but you're 45 years old and you need to get a higher return in order to retire when you're 67, for instance. Then we might say, okay, you've got a medium risk tolerance here and your risk capacity is high. So we're going to go ahead and lower. We're going to go ahead and move you up to a higher portfolio. And if you're 80 years old, and if you lost 20%, that would ruin you. We might move you to a lower risk portfolio. So the first step of it is just to understand what the tolerance is. But the second step of it is to understand what the capacity is. And when we know what your capacity for bearing risk is, we have ways of doing this quantitatively. We can run Monte Carlo simulations. It'll show you what your odds are at this level of return and that level of volatility. And so we can kind of come to a better portfolio that's going to do what we like to do, reduce your overall worries by uh, increasing the odds of you being able to make it, of you being able to make it for 20 years or 30 years or whatever that planning horizon is. So the lowest odds of you running out of money, if that's the highest priority, it might be that there are other things to consider too. Okay, so we got to get that down. Now, what's the next step? The next step is we're investing a certain percentage of your total assets. Of that percentage of assets that are going in equity, where do we put them? Well, I mean, we want to know where are we in the world? And we have been saying this for a couple of years, and we were a little bit premature for a bit, but it looks like we're kind of got it right now. We're kind of blowing it away now. And if the last 10 years the S&P made 7%, a little over 7, and the Russell, the small caps made 7, European stocks made a little over 1. Well, I'm telling you, for the last 40 or 50 years, not European, international, European, Asia, Far East stocks, Japan, Asia, Australia, uh, Europe, uh, all the developed markets in the world, over 40 or 50 years, they've done almost the same return. So it's this last 10 years, it's really the last 5 years, it's been a big anomaly. The S&P's made 13, the international 6, 3 years, 10 and 0. I mean, so yeah, guess what? International and emerging markets have to catch up. Now we can look at it on other metrics like price to earnings, price to book, price to sales, and et cetera. I don't want to bore you too much, but they're all good. So if we look at it just from this pure price you pay for a long period of earnings, 10 years of earnings, so the U.S. is now trading at a very high valuation, such a high valuation that at that valuation, according to research affiliates who are pretty good at this stuff, you can't expect to make much. So in the US market overall, and we don't buy overall, we don't like indexes a whole lot, but overall in the US market in the indexes, you could expect to make a little over 0% in real returns. Okay. Now you might make 15 to 20 in international and 20 in emerging markets. I can't say that these are going to happen, but I'm telling you that from where I'm looking, there's much better odds to be in those spaces. And guess what? We're way over allocated to those spaces. This is that same data from another perspective. Europe, Asia, Far East equity, emerging markets equity, higher return with a little bit higher risk expected for the next 10 years than US large or small. Okay, this is with equity. So we need to be looking internationally in emerging markets. For bonds, look, I mean, this is another part of what we consider to be socially responsible investing, not investing in US core bonds, not just investing in high yield either, not investing in any of these other that are way overpriced. We want to look at, emerging markets. We want to look at bank loan. We want to look at all these things, but especially, and I say this because it's very close to me, especially we want to invest in the lifeblood of our economy. We want to help these new companies that are going to be the future Microsofts, Googles, Amazons, and et cetera, that are companies that had angels start them, that had venture capital backing, that are now doing very well. They've got 20 or $30 million in earnings before interest taxes, cash flow. They're doing so well that they are growing more than they're willing. They're burning cash because they're growing, and they need money to finance their growth. Whether it's hiring more salespeople, whether it's hiring human resources people to hire more salespeople, whether it's buying trucks, whatever it is, whatever business it is, infrastructure, IT guys, who knows, but they need it. And so what they have been doing for the last few years, because after 2009, the banks stopped doing this, especially since they consolidated, especially since it's more profitable for the banks to sell variable annuities, mortgages, and other things, credit cards, than it is to lend to these people. They stopped doing it. And so the venture capital people who are interested in doing equity financing where they're going to hope to get 15% or better per year are loaning to these companies with their capital where they're only getting 7, 8, 9% per year. Okay, so they don't want those piddly returns in that market with the senior secured debt in that market. has the default since 2004 have been less than 0.2%. Wow, did I say that? 0.2%? Yes, crazy. Very, very, very low risk stuff, but it's not sold on an exchange. And we've recently found a way to access it through some of the interval funds that we use, like PIMCO Flexible Credit Income and some others that we will probably be rolling out over the next month or two that I'm doing due diligence on. So we're very, very excited about this space. I think it's just a wonderful thing because it's good for the companies. And I think it's a fantastic thing because, guys, I mean, I don't know what that return is going to be, but it's certainly 6, 7%, potentially more in fixed income that, did anybody see what I had here a minute ago? The core returns in fixed income for the next 10 years are expected to be less than 1%. That's plus inflation, so 3%, 3 or 4%. Wow, if we can add that in value on those, then we're really doing something good for our clients in addition to those companies. So again, here's the reason the banks have consolidated. There were these banks that are all now that bank, Citigroup. There were these banks, Bank One, Chase, Chemical, manufacturers became Chase, JP Morgan. Ooh, JP Morgan now. Okay, so you get Bank of America, you've got Wells Fargo. Similar story. You know the story. You banked with these people. So these guys aren't going to lend to those small, private companies. So there's no supply for it, but they need more and more for it. I'm going to kind of skip over this boring stuff. But you can see here, here's another middle market overall. Since 1998, the historical loss rate's been less than 1%. And the default rates have been 3%. That's of all, including the not just senior secured. And then you get a higher recovery. So you've got lower loss, lower default, and higher recovery, all which means lower risk. And you can see here that they've got very good fundamental characteristics in terms of the companies. So it's good stuff. Now, on to another topic real fast. When we were at Morningstar, talking to not only these behavioral psychologists and people about environmentally responsible investing and how can we do this and how can we do that, we also had the opportunity to meet with John Bogle. And John Bogle, this is just a great quote. I listened to his presentation and I agree with almost everything he said. And what I don't agree with is his love for market cap indexing. And quite frankly, I think that if he were a younger man, and if he hadn't already sold himself on this, if he hadn't already created a confirmation bias, if you will, that this is what he has to do, he might look at the world differently because market cap index just doesn't make any sense anymore. It doesn't make, and that's what all the money's in. It doesn't make any sense. I mean, I can show you strategy after strategy that has similar return and lower risk, or maybe a higher return for the same risk on a risk-adjusted return. I think it's the stupidest thing you can do. But I understand why people do it because it's something to do that's cheap, and they're not going to give all their money away to somebody else, providing, if and only if providing that they don't sell at the wrong time and buy at the wrong time. We just showed you with that game that that's what people are going to do. And I can also tell you that, we talked about the Vanguard S&P 500 fund. It's right there in that return. That fund itself, investors in it made 3% or so, and the fund itself made 7%. How can you explain it other than they sold at the wrong time, bought at the wrong time? So if you really buy into this and you do everything they tell you to do, you'll probably do okay. But talent exists. Sorry about that. Talent exists, and here's an example. And you might not be able to see this, and that's okay. I'm going to explain it. So pervasive, persistent, consistent talent. This is the talent of Robert Gardner. Robert Gardner is a great example because he managed a fund from 1995. He's managing money now. So there was a fund that he managed that I couldn't invest in because at the time I was at Merrill Lynch. I was at Merrill Lynch in 2000, and we didn't have a sales agreement. So I couldn't buy the, now it's called Wasatch Global Microcap. It was called the Wasatch Microcap Fund. From 1995 through 1/1/2007, it made 25% per year. I'm not kidding. It made 25% per year. And that's nearly 20% more than the index made and per year, 19% per year. And it had a lower risk. And it made money every year except for 2002. What? Yes. Because He kept the asset size low. So after I left Merrill in 2004 and I got out and I could buy it at Global View, I couldn't buy it because it was closed. It was closed for good reason. So when Robert opened the Wasatch Global Opportunities Fund in October of 2011, we jumped in there. Well, I jumped in personally, and then as a firm, when the market was clearly at a bottom in March of '09, in April of '09, we bought a bunch for our clients, and they're still happy they had it. And so he left in 2011 Wasatch and started Grander Peak. So we moved the money over from Wasatch Global Opportunities into Grander Peak Global Opportunities. That fund closed a couple years later. It closed in 2014 before it had a 3-year track and before it had a 5-star rating, which it subsequently got. And you can see it did very well. It's made 4.5% over the index. Okay, not 20. Come on, 20 is too much for anybody to ever ask. 3 or 4% is incredible. So similarly, Global Reach, another fund, closed in 2014. It's beaten the market by 3.6. And then their emerging markets fund made 6.8% per year in a market that made 2, which is 4.5. And now we have, pardon me, 2 other funds that are still open, that they open because they can do a little bit more mid-cap. I would expect the returns maybe to be a little more muted than that Wasatch Global Microcap Fund. But hey, I mean, if we can, they're already delivering 6 and 9% excess returns. So this is just incredible. It doesn't exist in nature. Happy to see it. Can't believe it's going to be that good, but we think it's going to be good. And we're constantly looking for these. So that's the reason. That's what drives me. Okay. The stock portfolio that I do now, I learned to do largely from conversations with portfolio managers over the years. I learned that there are certain fundamental factors that drive stock performance. One of them is not price, which is what drives the S&P 500 index funds. It is instead fundamentals like valuation, fundamentals like growth in earnings, fundamentals like quality. So it's really those 3 things. How much are you paying for what you're getting? What are you getting in terms of how does it grow? And what are you getting in terms of the quality? And quality is, guys, this is math. I can tell you what quality is. Quality is a high return on equity. Quality is a high return on total assets. Some people say quality is price stability. I don't buy that. I think earning stability is another manifestation of quality. Where do you find it? You find it in companies with wide moats. Companies that are so good they can keep competitors away. And there's about 200 companies or so in the world that are so incredibly good that those companies can keep competitors away and make a higher profit than their competitors for 20 years plus. So those companies, those wide moat companies, Morningstar has researched, they created an index that goes all the way back to 2002. And so if you were to buy the wide moat companies that are selling, the 20 companies that sell for the cheapest, according to their fair value, are selling for the biggest discount to intrinsic value, you would have made over this period 15% instead of 10, which is 5% per year more. And over this period would have resulted in over a doubling of wealth over the period. You'd have twice as much money than in the S&P 500. Wow, wow, and also wow. And we use an ETF that does this, and we use an international ETF that does this, yes. But we have other things that we think are even better, like the Grander Peak. But we have a stock portfolio that we run too that's much more tax efficient. So another thing that's great about these wide moat companies is that it's an easy ride. They generally beat the market over 1 month, 6 month, 1 year, 3 year, 5 year. I mean, it's almost like it's too good to be true. It's so good. I can't believe it's true. I listen to these guys talk about it all day. There's a guy named Alex Morozov. He's of Russian origin. I think he's from Chicago originally. He lives in Brussels now. I think it's Brussels. And he lives in Europe. And he is trying to find new wide moat companies in Europe every day. That's what he does. And I love talking to him. I love asking questions. And so they're finding more and more companies there that they think are narrow moat companies. Narrow moat companies got 10 years worth of competitor beat. And the wide mode companies, which are only about 200 in the world, have 20 years plus, or a lot more narrow mode companies. But so this wide mode index is just the wide mode companies, the top 20 of them. So what we have done at Global View, and this is, I don't know, 2.5, 3 years ago, time, passes by, and I can't remember what year it is. Oh, it is 2017. So anyway, I came up with this stock portfolio on those metrics, and I figured out, flew to Toronto to do this, a system where I can actually screen for it, and it tells me when to buy and sell, and I make sure that as it makes sense, what I'm doing. In this portfolio of great businesses, which the stock portfolio we run has a track record. This is a hypothetical. I have to say this is a hypothetical and back tested. But we've been doing it for almost 3 years now, and we're very happy with it. And the returns over this period beat the market after our 1% fee by about 4% per year, with turning the portfolio 23%, which means once every 4 years. Think about it. 25% times 4 would be 4 years. So, about of 20 stocks, what's that make? Five would change every year. And you can see that it's had incredibly good performance versus the benchmark in terms of downside, down a little over 20 in 2008 versus 40 almost. And then every year it clocks very close to the index or above it, it seems like, which we love. I mean, this is just too good. And it does not do as well when the market's going straight up. We saw that in the first quarter this year. And then when the market's a little more iffy, it seems to do very well. So it does better in the down market. That's what people want. People want to not lose money they can't make back. That's what we're trying to do. And so if we can take away some of the other things that are in the business, we can do this with the stock portfolio where appropriate, we do that too. So this is the stock portfolio that I run without any environmental, socially responsible constraints. If I want to go in there and I want to say, okay, let's see what would happen. What would happen if I didn't do coal? Well, hold on a second. If I don't do coal, there's no change, because guess what? There aren't any great businesses that are coal companies. Coal is not a great business to be in. Nobody, okay. So you can legislate this away if you want to, but it's not necessary. It's dying. Companies don't want to use coal as a fuel. Communities don't want coal in their neighborhoods. This is going to die over time. Everyone knows this. It's going to happen. We're going to have more natural gas. We're going to have more other things. We might have more nuclear power, which I'm frankly a proponent of. And one day we're going to be running on nuclear fusion or something like that we don't know what it is. One day we're going to be doing it. At the moment, however, less than 1% to 2%, depending on how you calculate it, of global energy is used by alternatives. This after 8 years of subsidies in Europe and the US, that's where we're at. Wind power is having all kinds of problems. Solar power looks promising. When I redo my roof, I'll probably put panels on there. But this is the kind of thing that's got to happen over time. I'm absolutely for fundamental R&D spending by the US government, subsidies for it. I'm for these things. I want to see it. But I don't have any good investments in that field. If I do, they're going to be found by Grander Peak Robert Gardner. That's what this guy does. He spends his all day, every day trying to find the best ideas of smaller companies, which may or may not be alternative energy. Probably not going to be marijuana stocks, quite frankly, which are selling at 200, 300 PEs. And there's a lot of risk in that in terms of, how long it takes for that to get a little more ahead of steam. But I think it will have a head of steam. But that's another question. So let's, without talking about it, if we take coal and alcohol out of this, we had 8.5%. Now we've got, you can't see this, probably it's so small, 8% per year returns. So we're losing 0.5%. We had a little higher risk here. It looks like the risk went up a little. We lost a little more in 2008. So it's specifically taken out the alcohol, taken out beer companies. Beer companies are great businesses. There are several companies that are great businesses. Just to, think about it. People that drink beer don't just drink it some of the time. They drink it regularly, whether it's on the weekends or every night or whenever it is. People drink beer, they buy more beer. Just like wine, just like liquor. If you drink liquor, you drink wine, you drink beer, you're going to buy it frequently. You're going to be a frequent and repetitive purchaser of it. Whoa, that makes for a great business. You're probably going to be the kind of person who prefers single malt scotch to rye. You might prefer peanut of the night, the Pinot Noir, okay, to Cabernet or Shiraz. Personally, I'm a Zinfandel guy because it's relatively inexpensive, and I do like Pinot Noirs if I can get them for an affordable price. But uh, blah blah blah. I'm 17 days into a 21-day cleanse right now, so I'm not drinking any of that. I can't wait until next Monday. So, no alcohol this week yet. Take tobacco out, boom, you're down to 6.6%. Again, you increase the risk a little bit more. Not a whole lot, but you increase the risk a little bit more because some of these tobacco companies are great businesses too. So this is what I can do in the great businesses portfolio, modify it for socially responsible. Um, I haven't had anybody take me up on it yet, quite frankly. I do have clients who take me up on, because they have to, because they're corporate officers, restricting certain stocks from being in the portfolio, and we'll do that. But I don't have anybody yet who's asked me for an alcohol-free, tobacco-free portfolio, but I'm happy to do it. So just a couple things here. Let me see if I'm getting out too far on a limb. I'm not. So I believe just going forward that we're at about the low interest rates we're ever going to have. And over the next 3 to 5 years, we're going to see interest rates go up. I think the economy is going to get better. I know a lot of people are worried about a recession being imminent because we haven't had one in a while, but we've been in a recessionary state. And so I think that we got to buy on it, because I think that we probably would have had a recession in 2012 if we hadn't had a second round of unprecedented quantitative easing, which is where the government literally prints money and puts it in the banks and makes it available to the economy. And so now you're staving off what could have been a deflationary downturn. So what this chart shows is the blue line in the upper left-hand corner chart shows how much money funds make better than indexes cumulatively since 1961. You can see that when interest rates were going up, they made a lot more money than indexes. But since 1982 or so, when interest rates peaked and they've been going down, active managers, mutual fund managers, have been doing more poorly than their index brethren as interest rates lowered, because there was a tailwind that filled the sails of everything. That tailwind's going away, my friends. And so if you're in an index fund, you might be in a stall. You might not be able to I'm not a sailor, so you might not be able to jib and jab and get out of this. Whereas if you're an active manager, you can. You can know what you can find within the market. What are the better opportunities? You can find things that are overwhelmingly compelling, that have a network effect, and that are great businesses. And you can see the lower right-hand corner just shows that in rising rate environments, active managers win on a yearly basis. And guess what, on the monthly basis? And we know this happened during the 80s, or during the 70s rather. During the 70s, when rates were going crazy, Warren Buffett killed it. He made 22% per year. Inflation was 8, so he was making 12% after inflation, and the index made 8. So the index was making the inflation rate making 0, and Warren Buffett and the 4 super investors of Graham and Doddsville that he writes about in a paper that he published, I think it was in 1984 or it was 1985, called The Super Investors of Graham and Doddsville. He writes about it. Those guys on average all beat the index by 12% per year. So I love it. We want that. Bring it on, baby. We're ready for it. We're prepared for it. We've been prepared for it for years. So, who influences us? Our clients. I'm sorry that's a faceless client. I've noticed that now when I wish it had a very happy and smiling face. Our clients are very personal to us. We're influenced by our clients. We want to give our clients what they need. If they want to look into socially responsible investing, we can. And most of them, again, would prefer not to take the alcohol out. There are a couple of good investments that we can do too, that strive to be socially responsibly in Asia with Matthews funds, for instance. But I really love Grander Peak, and I love investing with portfolio managers who have their own skin in the game, whose they live, they wake up in the morning to make money for their clients and themselves together hand in hand. And so last month, I was in New York. I visited with three of those guys, and we've been adding those to the portfolios because I'm very impressed by all three of the guys that I met with. The most impressive one, I think, is Abhay Deshpande at Centerstone. He worked hand in hand with Jean-Marie Evelard since 2000. He learned his technique. Jean-Marie Evelard was just a one of a kind in terms of his approach that from 1979 through 2007, he made, I think it was 14.5% per year. It's a very high number. And he only lost money less than 1% two or three times. He never lost over 1% in any calendar year over the entire period, including the 2000 to 2002 recession where everything got hurt. So they're we're really impressed that we can work with these people. But we paid the flight to go up there and the hotel and et cetera, et cetera. Now, if I'd had lunch with them and I didn't have time, I'd let them buy me lunch. That's all. We don't get paid in any way by anyone ever for anything other than incidental research that comes along with being at the custodian Schwab or TD Ameritrade, or maybe something that the fund families give us when we've already chosen to work with them. So we're not influenced by it. So that's about all I can tell you. There I am. God, I'm kind of fat looking. So I'm working on that. And there's Adam. This is Joey in the picture. That's Aaron. Kurt Schumacher wearing his pink shirt. Victoria, you can see him there. And there's Christy and Amanda. So Victoria, you have anything you want to talk about?
Well, I sort of have a question, but I don't know if I know how to say it.
Well, don't sweat it.
Okay. So I understand, going back to the beginning, I understand the bit about money not going to the big banks and how there's only 4 banks.
Yep.
And when you say emerging markets, you're talking about in emerging countries?
There's 22 different emerging market countries. The biggest ones, yes, are Brazil, Russia, India, China.
Okay, so like the BRICS kind of people. So my big concern, I'll just talk and you respond, okay?
Sure.
My big concern is when it comes to ethics is kind of the oligarchy and the oligarchs. So when you're at these mid caps and you're doing the emerging markets and all the stuff you were talking about, just in terms of good portfolio, are you kind of avoiding that by definition?
Well, I'll tell you this. So the oligarchs you're talking about in the emerging markets are really the state-owned enterprises.
Okay.
Gazprom, Lukoil, Surgutneftegaz, Norilsky Nikkel. Okay, there's a whole.
Good job.
There's a bunch of these boys. Well, I lived over there for a while, so there's a bunch of these guys, and you'll find that generally they're not owned in the portfolios because it's they're not as trustworthy. So if you look at somebody like Morris Capital, he's a guy I met with in New York. He invests in companies. It's so hard to say what's responsible or not. He invests in these companies that are very sound. They have sound balance sheets. So when you're in emerging markets, the biggest worry that you should have is that they have a lot of debt that's denominated in dollars or euros or whatever other currency, but yet the revenues and earnings come from local currency. Imagine the nightmare if you're in a country that's going through hyperinflation and they owe debt in dollars. Well, you could, if you had Brazilian companies that have a lot of foreign debt, very, very bad, like Petrobras would be an example. So if you own an index, you're going to own all of that. So what you don't want to do, Victoria, is own an emerging markets index. And so we could show you, and I can show Kurt how to do this, what the holdings are in some of the funds. You, for instance, might not want to own Copernic. Copernic is a fund that he thinks that those companies are so cheap, cheaper than they've ever been, that he owns a whole bunch of them. He owns some of the companies I mentioned. He owns uranium miners. He owns, which you might have an issue with. He owns, what am I trying to get at here? Hydroelectric power stations. So if those companies don't have a lot of foreign debt, they're going to be safe. How do you get a moat? How does a company get, uh, that moat? How do they get that moat around them? If you imagine like a castle with a moat, how do they build it? They build it by having something that their competitors can't do, which by definition in economics is going to give them an oligopolistic pricing type opportunity.
Yeah.
I mean, think about it.
Yeah.
You buy Apple. If you're on Apple, you're on Apple. iPhone, iPad, MacBook, etc.
Yeah.
It's all one ecosystem. Microsoft's trying to get me in the same thing. I mean, their Microsoft Edge, their new update, I can't use Internet Explorer anymore. I used to. It's not being cooperative with Chrome, which is from Google anymore, and it's frustrating to me, you know? So I've got to use Microsoft stuff because, or that, what do you call it? That I have to be, I'm in that world because of some of the software that I have still doesn't work on Apple. I mean, like the
Right.
Morningstar Office, and it just doesn't. So, but I prefer the Apple stuff, which is more expensive, but I prefer driving a BMW to a Volkswagen,
Yeah.
Um, so, we can look at it, but I think that so remember I mentioned the Muslim guy?
Yeah. The Sharia law. Yeah.
Yeah. So, man, the guy's so nice. A 68-year-old guy's a chemist. And, but he's been fooling himself all along. And now he wants to not fool himself anymore. And I'm going to probably have to tell him he's going to work with the Manna funds. It's just, you know,
Yeah.
so I'm just, I don't know what else to do. But the Mormons, these guys out in Salt Lake City, they're the closest to Muslim of anybody, according to this guy, the Muslim guy. They don't like tobacco and alcohol. They're investing in, and these are the same guys, and like the Boehner guys came out of, Romney and all those guys came out of that church, and I don't know why so many of them are investors, and they really want to find these small companies. They work so hard, so they're investing in these things that I think are just fascinating, and some of it's biotech. Let me just show you this. I snuck out earlier and got a swim in because I knew I wouldn't be able to do it tonight. So I've got all this energy. If we look at Grander Peak, and you should see this on the screen, look, it's got 5 stars. It had none. There's the index. Wow, 17 versus 8 on a 5-year. What? I mean, it's just too good to be true. So, but yet it's true over and over. Here's what they're owning. So this is Mawa. This is a U.S. company. Cleningen is a UK. Power Integrations is the U.S. Free Republic. Palfinger Agas. So I don't know what this is. Palfinger Agas in Austria. You know, but they're looking for companies that are going to be. I know they've owned, and I don't see it here now, a German company that's doing internet infrastructure in Germany. These smaller companies that could be the next, uh, you know, uh, that could lead to the creation of the next Amazon, or these are companies that don't have moats from Morningstar because they've researched these on their own. Here's Prestige International. It sounds like something out of a Will Ferrell movie. Prestige Worldwide. But I mean, these are really good companies, and they're not always right. They've got 230 companies, so you know. But I think that when you get in here, if you get on a call with these guys ever, the Grander Peak guys, you're going to be impressed with how they're looking into these things, and that they're looking for the future Microsofts, Amazons, and et cetera. So, you're investing in those, and that's socially responsible the way that I look at it. Because, Victoria, I've read a lot of things, and I'm worried about something that's this. And jobs are getting eliminated for 2 reasons, and it's not going to get better. Jobs are going to get eliminated because the first thing is globalization. So if you can do it cheaper somewhere else, somebody's going to do it, and they're going to capture the profit, and other people are going to lose jobs. The other one, and the more insidious one, is digitization. You put these two things together, you call it techno globalization. That's what Howard James of Cambridge says it is. There's another guy named Eric Brynjolfsson at MIT who calls it techno. He calls it just those two things: digitization, globalization. But digitization is where one person, and this is ridiculous, one person gets everything because they patent an idea. And that's not ever what capitalism was intended to be, because it's not one person that created it. It's a series of incremental improvements that cause something to happen. Now, I'm very happy that Bill Gates got so filthy rich from Amazon, I mean, from Microsoft. And you can find, Bezos, Amazon, and you can find they put everything together and they hired a team of lawyers and they got it and they claimed it. So we need to have more and more companies competing and creating these companies for tomorrow, so that that grandkids have jobs, meaningful work. And to me, that's the most socially responsible thing we can do. Because if I say I'm not going to invest in coal, um, I'm making an assumption that by legislating it away, that's going to help right now. When in fact, we know that it didn't help at all in the UK when they said no more coal. Well, there are factories that can only use coal or something like it. And since they can't use coal and you can't do it in England anymore, they're importing bituminous something, charcoal or something, from Canada, and they're having to ship it over there. So they're wasting more energy to get it there. They're polluting everything. It's all horrible. So I'm against these. I'm against one-sided or short-term goal thinking. I'm more of a, let's put the process in place where we can create transparency, we can see what's happening and fix it. So, that's my view of socially responsible investing. And I think that, if you want to look at exactly what your holdings are, we can do that. And you can say, I don't like that, and we can figure out, some substitute. Does that make sense, Victoria?
I'm so, yeah, I don't know if you noticed, but I disconnected for a while. I kicked my cord and accidentally unplugged everything.
Okay, I'm sorry.
That's okay, but I just came back when you were saying you thought the most socially. I didn't. I heard the second half of your sentence about the most, the best thing we could do.
Yeah.
And I heard that last part, and I don't know what you said for the first half of the sentence, but I think that I agree with what you said,
Yeah.
because with over the years I've tried to take this into consideration, and it's an elusive target.
Right.
And you may say, okay, I'm not going to invest in coal or whatever, and you're invested in a company that treats its people like serfs.
Right.
So, yeah. So I don't know how you define it other than these big principles.
So let me give you another one. So, again, the way I define it is I want to invest in things that I think are going to make the future better for our grandkids.
Yes.
And the first thing is that they give them jobs and opportunity to have meaningful life. Okay. So the other thing that I consider when I'm purchasing in particular, and more so purchasing than you know than investing, I think, but also investing to some degree, uh, is is the company consciously a capitalist? And so Mackey at Whole Foods, wrote a book on it, and he started a movement called conscious capitalism. I try, for instance, I shop at Costco instead of Walmart. That's me.
Mm-hmm.
You know, I like Publix instead of Ingles, but I go to Ingles sometimes too. It's convenient.
Mm-hmm.
So those are things that you can do that, how you vote with your wallet, so by working with us, you're making a conscious choice, I think, instead of working with the big bank. Um, and then investing with Grander Peak and Abhay Deshpande at Centerstone, and Amit Wadhwani at Morris, and uh, Laura Guritz at Rondour. It's a woman-owned. I'm not doing it because she's woman-owned. I'm doing it because they're working with Grander Peak. And I'm
Mhm.
sure she's super sharp, you know. She's got a great track, you know, of kicking butt on the index, like I showed you with the Grander Peak guys. So
Yeah.
those are things I admire. And, you know, by the way, you know, they're thinking about what they're doing too. So,
Yeah, I mean, I think that's one of the reasons I came to you guys is whether you get it right or not, it's one thing, but you're thinking about it.
well,
And
thank you.
that's really, or at least your Friday afternoon news articles would have led me to believe that. So,
Okay. Well, you know, we practice what we preach, I can promise you. You know, and so since you've been reading those, I've been to, well, I don't know, Chicago and New York, you know, visiting with people. So, you know, that's practicing what we preach too. And I'm invited to go up to Charlotte to speak in December to, you know, I'm on the panel, little old $200 million Greenville, South Carolina RA with the $25 billion Washington D.C. guy that you should have taken my advice last December. Let me tell you, not his. Ha ha. But anyway, uh, so, but he's a sharp guy, and you know that's some good stuff that we're interacting with these people. You know, we're you know I met with the chief economist of PIMCO in February. You know, there ain't anybody smarter at that firm. This $100 billion firm. And it
yeah,
wasn't just me. There were 9 other people in the room, but I got to ask questions, you know.
yeah.
And this guy worked for Ronald Reagan, you know, as a under Treasury Secretary in 1981 and 2. You know, he knows what's going on in the government. And anyway, it's good to have that perspective, you know.
So what does conscious capitalist mean? I mean,
So it
how
means,
is,
okay,
yeah,
so unconscious capitalism would be just shareholders. I
okay,
want to, you know, I'm going to maximize return on capital for shareholders. Conscious would be, I'm considering employees, suppliers, and shareholders, and
okay.
other agents, you know, whoever it is they're interacting with. They're trying to be aware. So
See the whole
it can,
picture,
big pardon?
see the whole picture, sort of.
Exactly. More holistic, more European. Okay. And so Mackey, what happened is he would have gone on a business at his first store in Austin, his, you know, little holistic, you know, health food store or whatever that was later became Whole Foods.
Hmm.
And so when he got flooded, it's a great book. He started off as a hippie and he realized he couldn't pay everybody the same. They couldn't run it like a communist. You know, he had to pay people that
Yeah,
worked harder and came to work more, you know, and so, you know, he evolved into more of a business owner type person. But when he almost failed and he couldn't pay the people he owed money, they gave him some time. So he carries that with. He's like, okay, well, you know, we're going to be hard on people, but we're going to try to help them. You know, sometimes things happen, and you try to help people through it. So you know that's what conscious capitalism is. It's you go to you know, you go to Walmart, you stand in line, and you don't have a person helping you.
right.
You go to Costco, there's a guy. I'm trying to get in Gary's line when I go to Costco because Gary is fast. I've known Gary for 10 years. I try to get in Gary's line. You know what I mean? So I'm going to go to Costco. And if Gary's not there one day on a, you know, whatever when I'm going, I'll probably ask, what happened to Gary? You know, uh,
Yeah,
there's a relationship with them, you know, and I mean, I go to, when I was doing Ironman, you know, training, I went to a guy named Frank Roth and, you know, he's charges more than anybody else and he's better than anybody else. But I don't know if he's that much better. But you know, the guy is a very special guy, and I'm willing to pay him. You know, so I don't have to get somebody to do my yard work necessarily. I've got a 15-year-old boy I could shake the whip on, but you know, he's going to be a professional cyclist. And you know what? There are people out there who could use the money for the yard work, and so I hire them. You know, I hire people to do stuff and maid to come in for my wife. And, you know, I mean, and my wife, I do it too, but I mean, I try to do it, but she's doing 80% of it. You know what I'm talking about? Probably I'm not as good at it as she is. So I don't want to muck it up. But we hire these things out, you know, so that's conscious capitalism.
okay, thank you.
You're welcome. Anything else?
I can't think of anything right now.
Okay, there's just one other person on here, Brian. Brian, you have any questions? I don't think you can ask me anything. But I'm going to go ahead and get off of here. I'm going to record this and we'll put it up on the website. Okay.
Okay, thanks a lot.
Thanks, Victoria. You guys have a great day, great night. Thank you for being on the call. Bye bye.
Bye bye.